The AIM market has been interesting over the summer. Of course, healthcare companies have been front and center. That is up until the point on Monday, the 9th of November, when Pfizer came out with its blockbuster news that it's looking good for the vaccine for COVID-19. All of a sudden, healthcare companies fell out of bed. Is this a buying opportunity? Where else can we find value in the AIM market? Let's catch up with a regular here with us at IGTV. It's Chris Boxall, who's the co-founder and Managing Director at Fundamental Asset Management. Chris, it's good to catch up with you again. Hope you're keeping well. Just quickly tell me what's been happening over the summer. I mentioned there are a couple of events over the last few days, especially for healthcare companies, but what's your feeling about AIM stocks at the moment?
Well, I mean, healthcare and the small healthcare companies on AIM clearly have had a great time. Many of the biotech ones, those involved in COVID testing, and everybody's been in love with them, and also some of the renewables groups. And then we had this big announcement yesterday, as you said, and the poor old UK biotechs, which were flavour of the year, have tumbled, which seems a bit of an overreaction. I mean, the opposites were incredible. We saw some stocks soar 30%, and some of these small UK biotechs tumble a similar amount. And it seems a bit premature, in my opinion, that suddenly we're not going to be pursuing the mass testing that everybody envisaged, and we think there could be some value in these. But that really hasn't been our space. We've been in one large AIM group, but other than that, we haven't really to participate to a huge extent on some of these early stage biotech companies, quite frankly, whose business models didn't exist without a pandemic. I mean, a pandemic has brought them all out, and many of these were totally unloved until recently, and some have done fabulously well, and hopefully will continue to do so.
Well, let's pick up on one of your long-term holdings, I know, in the healthcare sector. It's Abcam. Talk us through what's going on with this and your positioning now with this stock.
Well, Abcam's been a huge success story on AIM. It's one of AIM's largest companies, billion-plus market capitalization, and it's a huge success story. It's involved in antibody testing, as sort of the Amazon of antibodies. It's been growing a lot, and unfortunately, it's decided to dual list on the Nasdaq. Now, we manage a lot of money in AIM for inheritance tax planning purposes, and that's meant we've had to sell out of this stock on our IHT portfolios, which is a bit unfortunate because we very much like to keep it. And what you've seen is, you can see this on the graph, not long after the Nasdaq listing, the shares have been very, very strong. And so you've had this changing shareholder base. You will see a lot of the IHT holders come out and to be replaced by a growing number probably of institutions, notably probably some US institutions as well. Because we think this stock has a very bright future. So yeah, we've sold out of our IHT positions, but retained it on some of our general portfolios where inheritance tax isn't the primary interest, should we say.
Yeah, let's move on and take a look at some more of what is going on AIM. Another stock I know that you wanted to talk about was Codemasters. Now, I don't think we've spoken about Codemasters before. What's happening? What's it about Codemasters you like?
Codemasters is a video game developer, and it's been a huge beneficiary of the pandemic. And we've held it a while, a beneficiary of the lockdown environment, with more and more people playing video games. And we've held it for a while. It's one of two video gaming stocks we hold, and it's done very, very well. And it's received a takeover approach, partly cash, but the majority in stock, from a large US group called Take-Two. And to us, it looks a rather derisory offer relative to the valuation. Well, I think this is in many respects, this is a bit of a wake-up call for valuations as a whole on AIM. As I say, we think the offers are pretty poor relative to what we believe are its prospects, unless the prospects aren't quite as bright as everyone thinks. Now, management so far have said they're behind the offer. It remains to be seen what the major stakeholders think of this. But I can't see they're going to be that pleased. I mean, Codemasters is, as I say, really accelerated. It's got its new. It supports the F1 game, which is a very big game for it. Albeit it doesn't own the IP, the underlying IP, the Formula One racing game, and it is very much a racing game specialist. And it's identified lots of sort of add-on potential to the racing game genre. So we think it's an odd kind of offer, but its valuation is a lot less. It's seemingly trading a lot fairer valuation in many respects to its peers. But could this be a wake-up call as a whole for valuations? And valuations are clearly very, very elevated in some parts of AIM. So is this a sort of valuation wake-up call for investors?
Okay, let's move on and take a look at some more stocks worth looking at. GB Group is an interesting one. Now, this is a company I know from some research that I have done. A data company. Data is so important these days, and it seems like everybody needs and obviously wants data.
Absolutely. What specifically GB Group's involved in security, identification, identifying people, and it's been, again, its shares have absolutely flown, but it continues that theme that I brought in with Codemasters. Its valuation, nice business, but its valuation looks to us slightly mad. And again, does this reflect the overvaluation risk on AIM? The shares are, it's growing, but it's only growing organically at circa 10%. This is not a supercharged growth stock. It's been around a long time. It's clearly enjoying a good period, but it's not a supercharged growth stock. Yet it's trading at significantly higher multiples than many of for example, the large US listed, tech giants, who ironically are actually growing much faster and have much more robust and more attractive business models. So GB Group is another example of something that is this sustainable? I mean, just looking at it, I think it's trading at over 45 times estimates for September 2022. It's it doesn't tick any of the super attractive boxes in terms of return on equity, margins, or anything like that. It may be in a sweet spot, but again, it's this weird, dare I say, paradigm of overvaluation that a lot of people are being sucked into across a broad range of stocks. If the market is being critical of the large tech giants which are driving things, well, they should be even more sort of circumspect about stocks like this, because they're not growing as quickly. They haven't got their financial attractions, but they're at twice the rating, or a bit under twice the rating. So again, nice business, but where do we go from here, kind of thing.
Yeah, another one is Global Data, another data company I know that you want to look at. Let's look at that share price, because this, like the GB Group before it, it's seen tremendous gains across the last few years or so. This goes back, this actual chart goes back to 2011, but there's been a big step up back in 2013. But since then, it's been pretty much one-way traffic.
Yeah, it's another of AIM's £1 billion+ companies. Going terrifically well, but again, its valuation it looks insane on many levels, and relative to its growth, I mean, it's only growing organically. Pre-pandemic, I'm talking about, not in the recent hiatus. It was only growing organic about 7%. It's been very much an acquisition story as well, and you're looking now at a business that's trading at sort of 40 times forecast. 10 times forecast revenue. By the way, GB Group for them was trading at 17 times forecast revenue. I mean, these are crazy multiples relative to what are, to all intents and purposes, quite old companies. Whereas GB Group goes back to, I think, 1972, its origins. It was on the main market originally. So these aren't really new kids on the block, super growth, new kids with great ideas, a la Zoom or Peloton or whatever these other big young US names. These are well-established companies that have taken a while to get going, and now trading on quite wacky ratings.
As I said, companies are desperate for data. They're desperate for information about what's going on in the market for whatever sector. I mean, one wonders maybe perhaps it's just that people investing in these companies see these as potential takeover targets at some point by a larger business. Is there an element of that in what's been happening with the share price?
I think there's an element of that in a lot of the stocks on AIM, the market as a whole. I think for a traditional investor, and I think many investment managers are finding this, if you've come into this with a financial background, you're going to be struggling because traditional valuation methodology has been thrown out the window. We are living an era at the moment of concepts and mythical returns. And you look at some of the rhetoric and the narrative around stock market investing, it has nothing to do with profit or returns, quite frankly. It's all about the idea, the growth. Nobody seems to be worried about businesses that will ever actually make a real profit for people. They are more worried about some marvelous idea or something that may or may not come good. And I think that's sort of reflected in some of these very high valuations. So it's almost better to come into the stock market at the moment to make a return. You come from an art background rather than a financial one, because by applying traditional valuation a la Buffett or any other one of the well-known managers, you're probably going to struggle because they don't stack up. So it is quite tough. But yes, you're right. Data is a big area, but there are millions of these businesses involved in this space, and many very large ones across the water, which are growing very, very quickly. Maybe might justify a higher rating than some of these AIM stocks, in my opinion.
Another one you've got on your list of stocks to consider in this particular space is D4T4, another data solutions business.
Yeah, this is again it's a business that's been around a while. It used to be called IS Solutions a long time ago, and it's a lot smaller. It's sub 100 million market cap. We don't hold it, but we are looking at it very closely. We think it's growing. Well, to understand its growth it's changed its business model more to a subscription-based model, which the result is it's more in line with the way software is going, rather than a perpetual license sort of model that it had before. And it's revenues are going to take a short-term hit, earnings are going to take a short-term hit. But again, it's in the data space. It works with a lot of the financial services, consumer-facing groups, crunching data along a growing cloud-based platform called Celebris. And we think it looks more attractive from a pure valuation perspective. Again, very, very small and quite niche, but interesting growth prospects, a little bit more modestly valued. Again, not on many levels, not cheap. But you have to understand how its business model is changing.
What do you want to see the company do to get you interested in it?
I want to see it now deliver. It said it's changing its model. It's going to have to play catch up. I want to see that there is proof that this altered model is going down well with customers. And I'm going to want to see an acceleration. I mean, it can't, as I said, it's been around a while. Are we going to see a real acceleration of its offering from its customer base along the lines of this new model? It's got plenty of cash. It's very cash generative. I'd almost the mistake with many UK-based businesses, they're almost too conservative. So I'd like it probably to be a bit more aggressive and more adventurous in its growth profile. Once it captures the customer on a long-term sort of recurring subscription model, it's very, very attractive. So go out and grab those customers, pay more to get them if necessary, because once you've got them and if you deliver, they're not going to go away. So a little bit more adventure, but proof of delivery, really.
Yeah. When you sent across the list of stocks you wanted to talk about, I was really keen to see that you included Watkin Jones in this. This is a stock we've spoken about a number of times before. And if you look at the chart, I mean, this tells the story of the year, really, doesn't it, for this sort of company? This is a student accommodation business, isn't it, essentially? And look at that precipitous fall that we had going over just a few days in the middle of March. I mean, that they must have wondered what the heck. Well, everybody knew what was going on, of course, but It hasn't really recovered much since then. I guess this is partly going to be all about the Pfizer story or the Oxford University and AstraZeneca vaccine story whenever it develops. I imagine that's waiting for an opportunity.
Well, markets are clearly fearful that Watkin Jones' business model is sort of, as the chart suggests, broken. Watkin Jones is a developer, effectively an outsourced developer, addressing primarily up to now the purpose-built student accommodation market. So clearly, universities are having a tough time in the short term. Fears are now that this glorified building and development projects across universities is going to come to a grind to a bit of a halt. And Watkin Jones, that's where it's made most of its money over recent years. However, it's also moved into the private rental space. So it's the build to rent, which has also been attractive. Again, fears are that that's going to slow down a bit. So you've seen this almighty sell-off. We think it looks pretty attractive. It's a very well-managed business. It's sitting on net cash. It's not, technology isn't going to really upset its long-term model that much. And we feel that this is relatively short-term hiccup. Once we get through this problem, a vaccine gets out there in a year or so's time, Watkin Jones will be be doing as it has been for the last few years, developing a substantial number of properties. Its recent update was really positive as well. It showed there's growing interest from its institutions. It forward sells developments as well, so it's very low risk. It doesn't sit on these things. It forward sells them to investors. And it also manages the property. So once it's constructed out a new halls of residence, for argument's sake, on a university campus, it will be responsible for managing the beds as well. So it generates a long-term revenue stream from those. It's quite an unusual developer. It's sort of in the house building sector, but not. Different dynamics. And it gives you a nice yield at the moment, circa 6% forward dividend yield, low single-digit earnings multiple, if anybody's interested in these kind of metrics. But we think it could be a really good recovery play. Again, if you're interested in recovery play rather than growth stocks.
What's the balance sheet look like? I mean, these property companies or companies associated with the property sector, of course, like to load up with debt. And of course, at the moment, interest rates are so very low. Could it face a problem if it does have, if it is quite indebted, when interest rates do start to rise? Because that's a big concern, isn't it?
Yeah, it's sitting on net cash. So this, as I said, this is not a traditional developer. It doesn't hold great land banks. It forward sells as fast as possible. And it's sitting on net cash. So it has debt as well, but significant cash pile, and it's very cash generative. It therefore looks in pretty good shape. It's very risk averse. It's got a very, very small traditional house building bit as well, but most of its interest is in building on for universities and educational establishment, and also this new build to rent area that it's going into. So the balance sheet is very different to a traditional house builder.
Let's move on to your last pick, which is Elixir. Now, this is a company we've not spoken about before. I think it's quite a new entrant to AIM, isn't it?
It is, yeah. We like the look of it a lot. It's a management consultancy, so it's a challenger management consultancy. A lot of the founders, still founder led. Founder has a large equity stake. Came on the market a few months ago and has really delivered magnificently. It's put out several upgrades. It started to make a few acquisitions. We like the fact as well, this business came onto AIM. It's valued about £100 million. Came onto AIM, raised new money. There wasn't much sell down by existing holders, which we like. We never like too big a sell down. We like them to prove themselves in the market. Run by its founders, it's addressing a very large dynamic market. Management consultancy had a pretty good time lately. The likes of Accenture, huge businesses. The founders came out of large management consultancies. And, it's addressing such a big market that's growing very rapidly. And it's done well for its clients over the pandemic in helping them with this technology change, this acceleration of new technologies. And it's been acquiring in the digital marketing space, which we think is quite nifty. So we like this business, and we think it could do very nicely.
You say the business is still owned by the founders. It's relatively new. What happens with businesses like this? Just explain where it goes from here. I mean, what do they do? Do they build it up and sell it on? Do they build it up and divest themselves of some part of it and bring in partners? What happens with a small AIM company that wants to get going?
Typically, a small AIM company comes to the market hopefully to raise new capital, and sometimes it's not about raising new capital. It's more established. If the founders want to get out, it's largely about the founders selling down. But in this instance, and what we like, and we think investors should like about companies coming to the market, is they have a real growth profile. It's not about an exit. It's more about growth and the founders going to the next level. And so we have reasonably youthful founders, not that old, shall we say, in this instance, who are joining AIM to raise new money to clear off existing debt and to give them a little bit more to support acquisitions. So founders have only reduced their stake by a relatively small amount. The disadvantage with that is that the stock isn't that liquid. Clearly, because a lot of the shares are still held by founders. So there comes a point where either they raise new capital to support growth, or they sell down to attract new shareholder interest to improve liquidity as well. We never like our founders selling down. Unfortunately, there comes a point where they have to really. Sometimes that hopefully the shares go up a lot, and they just to diversify their own interest, business interest, they dilute. But we love growing business. We think everybody should focus on growth. A company joins a stock market, a young stock market like this, to support its growth. And this is very much what Elixir is all about at the moment.
Yeah. Okay, all right, Chris, thanks so much indeed for explaining that. That's Chris Boxall from Fundamental Asset Management, taking a look at some of the AIM stocks on the move in the wake of what has been a really interesting summer for this market here in London, and some stocks as well that have been beaten up as a result of some recent activity. We'll see whether or not there's any progress in those in the months to come. That's Chris Boxall from Fundamental Asset Management. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.